Good afternoon, Scott Redler, T3Live. Sorry for the little false, whatever that was there. Anyway, trying to get this out because I have to run today. Today, market gap down. Not really much opportunity the entire morning. It was one of those gap and goes, slow bleeds. And it did get into the area that we talked about. I talked about like 1187 to 1195, that support from October. Definitely not a spot to be shorting down there after 5 down days, but an area to look to buy for some type of bounce. And I know we tried a few of them in the early morning and they didn't work. And on the radio I was talking about death by 1,000 cuts, which what you have to do when you're trying levels versus levels until finally something changes a bit. And then around, I would say, 2 o'clock there was a bit of a move. And then on the radio I tried to talk through how to stay with a portion of it and then add some based on small micro patterns. So let's just quickly take a look at that. So here's the spiders, here's the SPX. And just real quickly again, I like to keep showing these patterns because they do repeat themselves, and I don't do it because I'm trying to beat my chest or do whatever it is, which some people think. If that's the way you think, it is what it is. I want to show how the move transgressed once again. Like this was that low, this was that October 4th reversal, that day to take notice. Here is where we didn't pull in. I think this was not even 25%, it was nothing. Here's when it showed commitment, you could have added on. And then you had, this nice little wedge type of pattern, right? Held above this mini downtrend, and then you had to move into the prior resistance, which was 1292, the whole range that we said, or the whole target from right around here was 1250 to 1300, and here's 1292. Then 2 distribution days, pretty harsh ones, guys. This pulled us back to the 38.2% retracement, which for the first time since the October low, the trade and the speed changed. Then you had a bit of a move back. This was when we were all long, and then we all got blindsided again. One down day just engulfed all of these. Another powerful down day. Both these 2 days were a lot more powerful than these inside days. And then we talked about the wedge. We talked about the range getting tight and to be on toes because either we're going to break to the upside or the downside. Here was that downtrend where we failed. This was your way out. And then today we came into 11. The low I think was 1183. Bounced a bit off it, and now everything is just different. Now you've heard in the media over the course of the past month or so, if you come to me in the back, you've heard that a lot of people are going to be chasing performance, and that really has changed. Now you have a lot of individuals out there that actually outperformed the benchmarks. Okay, they actually played what I just showed you and perhaps sold into strength. And then he maybe even didn't sell on the highs. There was a lot of good trading in there during that 6-7 weeks besides what went on in the first part of the year when we broke that head and shoulders top pattern short. So there are a lot of guys now that are up decent amount for the year, could be 4 to 8 to 10%, while the indices are now down 3 to 5%. So what do they want to do? They don't want to do much. They don't want to ruin how they look. They don't want to ruin their bonuses. So they're pretty much somewhat on the sidelines. Then you have those who missed, if you go back to the chart, who missed this nice move from October 4th, didn't believe it the whole way up, and everyone was talking about now if we go to 1320 to 1350, they're in trouble. They're going to be down 5 to 7% for the year, and the market could be up 5 to 7%, and they look like they don't deserve their allocations. So once we just broke this area and the momentum left, they now don't have to chase the market. They could pick compelling spots because if they were down 4 or 5% and missed a big part of the move, right now the indices are still probably down 3-4% again. So they're in line with the market. So now they just have to trade in line versus be pent up to chase it. So anyway, at this point, we do have a new point of reference. We have that 1183. If you go to a few different stocks, Apple, if you take a look here, it did hold this 200-day and it actually traded through. Remember I talked about, likes to be cute. Maybe it'll trade through the 150-day and stop some guys out and then not really reach the simple 200-day, which was really down at 363, went to 365. So what it did here is it pierced, okay, the 150-day got some people stopped out, but held the 200-day for now. So sometimes it likes to rally a little bit. Maybe it tries to fill this gap over the next few days. And if that's the case, maybe we get a small bounce into Thursday at some point, back to 1205 to 1220. And that would be pretty methodical. Unfortunately, this isn't a really methodical market. In a normal market, you would think after 5-6 down days, we just held the level, maybe some pressure leaves and we could rally back up, get people feeling good for Thanksgiving, and maybe people will go out and spend. So that's my whole conspiracy theory. And if that were to happen, you would probably see these spiders, go back up, fill this gap, which would be a decently nice, which would be a decent move because we're off the lows. We're off this level. Okay, this is the level that I was talking about. And then, maybe even go a tiny bit higher. So this, if you sold this correctly, which a lot of you guys did, if you sold 124.50s, you had the luxury of buying back 119.50, and maybe we get a trade to 121, 122, and then see if maybe we could even short that. But that would be methodical. And right now, I'm not sure things could be methodical with what's going on in Washington with the super committee or the super idiots, whatever you want to call them. I'm not going to get political. And then obviously everything going on in Europe, where yields are exploding over 7%. No one knows solutions there. You have people now talking that Germany is going to leave the euro so they could devalue it and get their countries competitive so we can all go there and vacation for the cheap, which you can't do now because the euro is a trapped mess. So we're going to be dealing with this type of situations for a long time. Europe's not going away. Our problems are not going away. The market's going to have these big ranges to trade, within this bigger range, and you have to really actively manage it, and you can do it. We've been trying to do it, 3 times. I'll post my lecture from Vegas. I talked about 3 times, even if you're not a professional trader, that you could have maneuvered these ranges and saved some cash flow and created some alpha for yourself. But for right now, we have a new point of reference. The ags were actually a little bit stronger today. If you take a look, they actually got a green bar. They held this support level. So the support level universally that I was looking at was this support level back from early October. Okay, a lot of these all broke those wedges and are all now testing this zone. So first time they held. Wasn't a great trade today. Maybe you get a little bit of follow through. OH is also, it couldn't quite go green, but held above that level, and it could rally a little bit. Look at Goldman Sachs, actually, a lot of guys made some money there. It went green today, woohoo. Held versus low. Maybe it's got some room back to this 95 area or maybe even 98. Remember, we talked about Goldman Sachs a few different ways to measure it. This is when it broke this one area, and this is when it broke 98 on Wednesday. So maybe it tries to come up and retest this zone before it goes lower. You tend to get a few day moves in this. Here was 2 days, here was 1. Who knows? Little leadership today, nothing that great. And I'm going to get into a lot more tomorrow. At this point, I think a lot of people are maneuvering the market pretty well. You're trying to play the probabilities a bit. Today, even though we were weak in the morning, it was definitely a difficult trade to try and be short. In the same way it was really difficult to be long. You could have dissected $1 out of the spiders on the way down if you were perfect. The same way maybe you could have dissected $1 out of the spiders on the way up, or a little bit more. So not a lot of room for error in there. And with the charts or the stocks, there was a little bit more, but there was a little bit more risk. I pretty much stuck to the spiders today. Maybe tomorrow I'll look for some relative strength and weakness to see if I could trade a few different stocks, once the market opens with a little less risk. But for now, the time is to be risk off. The time is you're not going to make, I don't think you're going to make your year in the next 4 to 6 weeks. It's really going to be hopefully the bulk of your year is in, and now you add a little cash flow and you try and stay out of the way. And if things develop, maybe we get a few really good days in there, which could make your month and make you smile through the holidays. But at this point, it's really risk off. I'm long small spiders. If we do gap down, I think we could trade out of it, and it's limited risk. I said I would be trying to be long between 118.75 and 119.50, so I like to put my money where my mouth is. And we'll see how it materializes. We'll see if we can get a small trade, and then we'll figure it out from there. But for right now, if you're in macro tier 1 and you were in there, if we broke 1100 back on October 4th and you were staying with it, hopefully that's all you're in. The time for tier 2 and 3 are well behind us. And if you're trading now, the pressure's off. Just make some cash flow back and forth, and we'll look for some more clarity. This has been Scott Redler, T3 Live, the recap. See you at the morning call. Have a good night.